my name is Brian Uhler, and I'm a fiscal and policy analyst here at the LEO, and I'm here to discuss our new report, Managing California's Insolvency, the Impact of Federal Proposals on Unemployment Insurance. This report covers four main topics. First, the report provides a background on the Unemployment Insurance Program, or UI program, provides a status update on the UI fund insolvency. Second, the report discusses three recent federal proposals which have been introduced to address UI fund insolvency issues in California and many other states. Third, the report examines the impacts of these proposals on California's program. And finally, the report provides recommendations for the legislature in dealing with the insolvency issue moving forward. The Unemployment Insurance Program provides weekly benefits for workers who have lost their job at no fault of their own. In California, workers can typically claim up to 26 weeks worth of benefits. However, during periods of recession, the federal government usually provides for this duration to be extended. The program is financed by contributions made by employers. These contributions have both a state and federal portion, which in California are levied on a taxable wage base of $7,000, which is the minimum allowable under federal law. Beginning in 2008, UI trust funds in many states, including California's, came under stress and started to become insolvent. A UI fund becomes insolvent when the benefit payments out of the fund exceed the balance in the fund and the revenues into the fund. To continue payment of UI benefits, states sought loans from the federal government. As of June 2011, California's outstanding federal loan totaled over $10 billion. Carrying this outstanding federal loan poses two ramifications for California. First, the state is required to make annual interest payments to the federal government, the first of which is due in September of this year and is expected to total $320 million. As you can see in this figure, these interest costs are expected to grow over the next few years and will remain in the hundreds of millions of dollars for the foreseeable future. The second ramification of California carrying an outstanding loan balance is that its employers will face automatic federal tax increases beginning in 2012. In 2012, these tax increases will total about 300 million new contributions paid by California employers. Three federal proposals have recently been introduced to address UI fund insolvency issues in California and several other states. Two of these proposals present a comprehensive solvency plan aimed at ensuring long-term solvency of UI funds in many states. The third proposal, while not intended to be a comprehensive solvency plan, does make significant changes to the UI program and could provide for some improvement in the solvency of UI funds in several states. The first solvency plan was included as a proposal in the President's 2012 budget. The President's proposal makes three main changes to the UI program. First, the President's proposal would suspend state interest payments in 2011 and 12. This would save the state about $800 million in interest costs in these 2 years. Second, the President's proposal would suspend automatic federal tax increases on employers in 2012 and 2013. This would save California employers about $900 million in those 2 years. Finally, the President's proposal would increase the federal minimum taxable wage base from $7,000 to $15,000 in 2014 and index the taxable wage base to the average annual wage in subsequent years. In California, this would result in the doubling of the contributions paid by most employers. The second solvency plan, titled the Unemployment Insurance Solvency Act, includes identical proposals to the President's and makes two additional changes. The Act would provide states the opportunity to apply for forgiveness of a portion of their outstanding federal loan in exchange for developing a plan which gets their fund to certain solvency targets. Also, the Act would provide states additional incentives to reach certain UI fund solvency targets, such as increased interest paid on positive UI trust fund balances and decreased federal taxes paid by the state's employers. The final proposal, titled the Jobs Act, makes two significant changes to the UI program. First, the Jobs Act would eliminate 100% federal funding for the recent round of federally extended UI benefits and remove the obligation for states to continue paying these benefits. Instead, the monies that would have been used to pay these benefits would be transferred to states in the forms of block grants, which could be used to continue payment of the extended benefits, repay the state's federal loan, or fund employment training programs. The second major change proposed by the Jobs Act would be to tighten eligibility requirements for UI benefits by instituting two new requirements related to educational attainment and job search effort. All three of these federal proposals would likely result in a positive impact on the solvency of California's UI fund. In our report, we provide a detailed forecast of the impact of the President's proposal on California's UI program. As you can see from this figure, the President's proposal will provide a significant improvement in the solvency of the UI fund as compared to current law, and would allow for repayment of the state's federal loan by 2016. By allowing for this earlier repayment of the federal loan, the President's proposal would reduce state interest costs by $1.7 billion. To achieve this increased solvency, the President's proposal would institute significant increases in employer contributions. As compared to current law, the President's proposal would increase total employer contributions by about $13 billion during the period 2012 to 2018. We note that this increase in employer contributions could have a negative impact on employment growth as the state's labor market recovers from the recent recession. In our report, we make recommendations for the legislature as to how to handle the UI fund insolvency in light of these federal proposals. First, we would like to emphasize that the state's UI fund insolvency poses significant problems for California that should not be ignored. However, we do recognize that the presence of these federal reforms does complicate the decision for the legislature as to how to handle this issue. Given this complication, the legislature could delay long-term action over the next 2 years while they wait and see what the ultimate results of the federal actions will be. During this period, the legislature may wish to consider stopping the growth of the UI fund deficit by bringing into balance UI fund revenues and UI benefit payments. Although a wait-and-see approach may be appropriate over the next 2 years, we recommend that the legislature ensure implementation of a long-term solvency plan no later than 2014. As discussed previously, if federal proposals are enacted, this may require no additional action from the state legislature. However, if no federal actions are taken, the legislature should act to adopt its own comprehensive solvency plan. In developing the solvency plan, we recommend that the legislature consider a balanced approach that both increases employer contributions and decreases benefits paid to UI claimants. In our report, we outline a plan which can be used as a starting point for the legislature to consider in developing such a balanced approach. To read the complete report, please visit our website at www.lao.ca.gov. For additional questions, please feel free to contact our social services and labor section here at the